Welcome everyone. So today I'm going to teach you how private money lending works, some of the things that you need to be considering and looking for when you do a deal, and ultimately just some ways to analyze a deal and make sure that you have the right documents in place, okay? So what we have here, this is again private money. So this is one of my favorite investment types. It's my favorite because a few things. One, it is passive. It's an interest payment that you get every month based on preset terms that we'll talk about here in a second. It essentially takes an hour or two of work, and that's about it. And then you're following up on your payments, you're tracking the progress of the project, and ultimately you're really a passive partner while still making a nice return. Now, on average, my clients that use this, they earn between a 14 to 20% annualized return on their money. That means with their interest payments and other parts of the deal, their total return on their investment annually is between 14 to 20%. Pretty attractive. So let's get started. So a few things that we'll talk about. The first one is, what is private money lending? This is also known as hard money lending, bridge loans, all sorts of street terms. But at the end of the day, what it is, it's someone that doesn't want to go the traditional route of a loan, and they want to use someone such as yourself or my money and put it in a contract like an ordinary loan. And then for the convenience of not having to do appraisals, not having to work with a bank and all the rigorous process that a bank puts you through, which usually takes 30 days, they can do private money lending or hard money lending, pay higher interest, but get the funds much faster. And in real estate, you gotta keep in mind, there's not many deals out there right now. So time is very important. They would rather pay the higher interest, maybe it's $2,000 to $4,000 extra over the project, than have to wait 30 days and potentially lose a deal. So time is really important for the people that are using hard money lending. Who uses it? Usually real estate flippers. That's usually who my clients lend to. That's who I lend to. All of the people that we give money to are people that are picking up distressed properties, getting hard money to use for the rehabs or the purchase and rehabs of the property. Okay, so that's what private money is. It's a faster way to get capital versus the traditional bank route. Okay, so what are we seeing for terms? Now, this really all depends, but typically our deals are 11% and 3 points, and I'll explain what that means in a second. But now, it depends on the team that we're working with, but it's at least 10%, somewhere between 10 to 11% interest that they're paying you. Now, this interest is paid monthly. So what this means is 11%, okay, right? So it's 11% divided by 12. Okay, this is 12 months. So it's 11% paid over the course of a year, but paid monthly. Okay. Now that number is, there was a day I could do this in my head, but not anymore. So here we go. So they're paying you 0.916% each month. Okay, that's the number that they'll pay you each month. So let's just say, for example, you gave $100,000 in a loan, okay? They would be paying you $916 per month, okay? That's your interest payment, okay? Interest payment. Apologies on my handwriting. So this is what you get paid each month. Now, this transaction or this setup is in the document that we call the promissory note. Okay, now in this note, it's going to say that such and such LLC or such and such borrower promises to pay according to a few things. The interest rate, right? They agree to pay you this interest rate based on an annual term. They will pay you a monthly payment of $916. This will be in the promissory note. And this is one of the things I review for my clients to make sure that this is in fact in the note, okay? As well as your name, your correct address, the borrower's name, the borrower's entity name, if they have that in the borrower's address, okay? Now, one thing that's really important, when we do deals, I said before, it's 11% And then also there's something called points. A point is basically a percentage point paid to you for the total amount at closing. Now what I mean is this. Typically terms that we see in deals are 11% and 3 points. Okay? So now in this deal, they would pay you $3,000, right? Which is figured out by taking 3% times $100,000. Okay, that's $3,000. So what happens is when you give the money, the day it closes, you have two options. They can send you a check for this amount, or what you'll do is you'll wire the funds, $100,000 minus the points, right? So you'll send them a wire of $97,000. That's the same thing as getting a check. It's just easier, but they're still going to pay you the $916 every month, right? So right away, you made a 3% return on your money. Now, what I do with my clients is we lend to what is called turnkey providers. Now, turnkey providers, again, they'll buy a distressed asset or distressed property. They'll turn around, they'll rehab it, and they sell it to an investor that wants to buy a rental property for investment. Okay. Now, why I do this is because these properties have usually more simplistic rehabs. These teams are turning around the properties in usually 3 to 4 months. And the way this game works, the way that you maximize your return is the faster that you can recycle this $100,000, the more your return on your money is, because it's all about points. Okay. Now, interest is great. Every month they pay you. That's fantastic. That's additional return. But if you do 4 deals in a year, okay, 4 deals, and you get 3 points per deal, you have a 12% return on your money just from the points, right? 3 times 4 equals 12. That's 12 points over the course of a year. That's 12% on your money. That's really good, okay? And on top of that, you would get an additional 11% on your money. So in my scenario that I just said, that would be a 23% return on your money. Really good for doing not much work. Now, what we do see is typically we're doing between 2 to 3 deals per client. So if you gave me $100,000, we would be able to probably do 3 deals a year. Still, you're earning 9 points on your deal plus your 11%. Okay, that's how you're getting that 20% ROI or return on your investment. Okay. Okay, so again, the big documents that you're going to be wanting to look for, the first one is called the deed of trust. And what the deed of trust is saying, hey, look, if you give me or if my client gives the borrower the money, the borrower promises that if they do not pay, according to the terms of that agreement, they will hand over that property for you, or to you rather, right? So let's say there's a property at 123 Main Street. It's worth $50,000 as a purchase. You give them $100,000 to do the deal. Now, what's going to happen is if they don't pay back you or pay you back within the term that you set, and usually that is, I said a 6-month term, meaning that if they don't pay you off the entire loan in 6 months, you get the property. And I'll explain in a second how we make sure that you're going to be out ahead if they give you the property. We'll talk about leverage and we'll talk about risk in a second. But so this deed of trust is detailing in the document that if they don't pay you off according to the term, and in this case 6 months, that property is yours. That's it. They default, they foreclose, you're the bank, you get that property. Okay, that's what that is all about. That's also called the first lien position. Okay. Again, the note, as we explained in the example, that's providing details about the interest, how much they'll pay you, who's paying who, and so forth. Okay. 2 important documents. There's something called title insurance. And what this is to say if there's a bad issue on the title of the property, right? Every property has a title. It's recorded. It says who owned it previously, who owns it now. That's a piece of paper that mentions ownership. If there's a problem with it, maybe there's back taxes, maybe there's a lawsuit with the title, the insurance is going to cover you in that situation. And what's nice is the borrower pays for the insurance, not my clients. And that usually costs between $400 to $800. So when you go to close on this deal, the borrower is going to pay about $2,000 of what is known as closing cost. That's going to have lawyer fees, it's going to have title insurance, all sorts of other fees to do the deal, okay? The only fees you pay as a client is the fee to wire the money into the account, and that depends on your bank. Usually it's 25 bucks. That's what it costs to wire the fees or the funds, okay? Now, there's something else that you get with me in all the deals that I do, and it's the escrow insurance. My escrow company says if you wire escrow the money, and for whatever reason something goes bad while the money is in escrow, they're going to insure the amount of money that you provided, and if it goes wrong, you get that money back through the insurance. Okay, so again, deed of trust, that's the promise that if they don't pay you off, you get the property. The note has all the terms of the finances, the payments, interest payments, who's getting paid. The insurance documents to protect any sort of mistakes or things that we don't see. And then lastly, really importantly, again, I review this for my clients, the closing document. This is what will show how much you're getting for points, any sort of fees that the borrower is paying. And here you'll see all the fees that are happening in the closing process, okay? So these are the 4 documents. That's the way it works. Now let's talk about how to look at a deal. Okay, we're back. So in the last segment, we went over the documents that are a part of the process. In the previous document, we talked about how private money works, kind of the basics within the payments and points and terms, right? And again, points, just as a refresher, is interest paid on the day of closing. So 3 points equals 3% of interest, okay? So now I want to talk about actually looking at a deal, right? And I'm going to use an example. Let's say there's a turnkey, investor or provider. They find a property for $40,000, okay? And they say, hey, client, I need money to buy the property as well as to do the rehabs, okay? So $40,000. And then they then tell you, and we have the details of the scope of work, that my rehabs are going to cost me $20,000, okay? And by the way, this is an example that I see all the time, very standard. Most of our deals are between $50,000 and $100,000 a purchase, and rehabs are between $15,000 to about $40,000 in rehabs, okay? So again, purchase, $40,000, rehabs, $20,000. So at this point, they have a total cost of $60,000, okay? Now, there's something called loan to value. And loan to value is, okay, well, how much is the amount of capital that you're giving or the loan that you're giving them versus the after repair value, okay? And that's what the V is. The V is the value after they rehab it, make it look nice. What would that property be worth? Okay, so in this example, let's assume that the property is worth $100,000, okay? So in this, it's going to be $100,000, okay? Now, I have a thing in my risk analysis I do for all my clients. Our LTV is never higher than 70%. I like to keep it around 65% or 60% even. Obviously, the lower, the safer, right? The lower is lower leverage. So lower leverage means less risk. So if they have this, I will lend, the terms are 90% of the capital need up to 70% LTV, okay? What that means is, in this case, 90% of $60,000 is $54,000, okay? Now, that happens to be, let's just do the math here, $54,000 divided into 100,000 is 54%. A 54% LTV, okay? That is very attractive. That's a low leverage deal. What that means is, you can see, because you would give $54,000. Okay, so this right here is the loan amount. This is the amount of capital that you're going to give to the borrower, okay? Now, the remaining amount, which is $6,000, they have to bring to the table at closing, okay? So you can see the reason this is important, because if you recall in the previous segment, the deed of trust. Well, let's all of a sudden say they take your money, they run off, and you're left with the property. Well, the property, if you rehab it, is going to be worth $100,000. Meaning, if they take off with your money, you get that property. And we know that the rehab is $20,000. So let's say you were able to call a contractor, and let's just say even with them, you have to pay $30,000. 30 plus 40 is $70,000. You're still able to do the rehabs, own the property since they now gave it to you because of that deed of trust, and still profit $30,000 on the sale. And that's why leverage and LTV is so important. You don't want to give them too much capital, because if for whatever reason you then own the property, you don't have a lot of margin, right? So lower LTV is better. And that is why one of our items within the risk score that I provide my clients is based on the LTV. And that's why I try to max out 65, 70%, no higher than that. Just in the worst case, you could do the rehab yourself and you could make a profit, okay? Now, there are some other items that I want to talk about that goes into the overall process of measuring a deal, okay? Now, if you think about it, one of the key things in these deals is the amount of incentive for the borrower to do the deal. And there's really two things that I look at. So when I get a deal, I say, okay, great. I know what the potential profit is. They stand to make around $40-some thousand, or between $35,000 and $40,000 on this deal. That's their upside. That's a really nice profit margin. But I also want to understand, and sorry, by the way, I like to see deals that have at least $7,500 of profit. Anything lower than that is too risky, in my opinion. That tells me that, one small mistake in the rehab process might make them go underwater. And why would they do a deal if they're not making any money, right? So they'll probably run off with your money, and then you have to take it over. So I like to see upside of at least $7,500 in profit. That's a really important fact. So that's the one piece. But I also want to consider, okay, well, what if, the market turns south, they can't sell the property, what then happens? Okay, well, as a rental, if they rented it out, would they cash flow and still be able to pay you your interest payment of $900 a month, or in this case lower, but whatever your interest payment would be in the scenario, can they pay that? Can they pay the insurance, property management, all those items and still make money? And so we look at the deals and we say, great, it's low leverage, it's safe, fantastic. But if they had to rent it and couldn't sell it, would they cash flow and still be able to pay my client their monthly payments? That's a big factor in our risk, because again, in the worst case scenario, we want to make sure that they'll still do the deal and be able to pay you in the end, okay? Now, so those are the two things I look at for sure. I then look at, again, the risk, the LTV, and the leverage. And if that looks good, then what we look at is to say, okay, well, as a property on the market, what is its marketability? And what I mean is, people don't want to live in F-class properties with 1 bedroom, 1 baths that don't have a nice curb appeal. We want to have a property that is very marketable. Okay, so looking at things like school districts, it doesn't have to be perfect, but it can't be the worst. Looking at things like crime ratings, it doesn't have to be perfect, but it can't be the worst. And then looking at the overall property, does it look, or could it look decent from the curb? If it's something really bizarre, like a triangle house or something, people are probably not going to buy that house because they don't want that style of a home. So look for very simple homes, easy layouts. Over 4 beds, I get a little concerned because most people don't want huge houses. So 2, 3, 4 bedrooms, or 1, 2, 3 baths is kind of what I look for. Somewhere between 900 to 2,000 square feet, give or take. And there's nothing wrong with putting your money in a C or D class property for private money, but generally, you want to make sure that across the board it has nice curb appeal, and obviously, the better the property in terms of schools and crimes, the higher the chance that the borrower will be able to sell it in the end. Now, I will tell you, my team out of Kansas City, we primarily focus on C and D class properties because they have a long list of buyers that buy only C and D class turnkey properties. So for them, they really know their niche, and they really work out quite well in that C and D class. So once I run all those items together, I get a risk score. And I won't tell you the algorithm behind how I come up with the score, but know that I analyze these 4 areas. I put a weight on each of these areas that I feel are most important. And then we come up with a risk score. And that risk score will tell you, okay, well, here's where it falls on the risk spectrum. Do we think we should do the deal based on all that we know? Okay. And that's how I look at every single deal. I give my clients that analysis. And if you're taking the course, you already have that tool that you can use yourself when looking at deals, and all of those algorithms are built in there. That's the exact tool that I use to do all this math. So that's private money lending. It's somewhat complex in some ways, but once you get the hang of it, it's really not. And it's one of the most passive forms of investment that I know. And I do think people should be considering it because it does produce income, unlike stocks or unlike things that sit in a 401k. So that's private money. Hopefully you learned quite a bit, and looking forward to seeing you do some deals.